The market melt-up is on. It seems like every day and every week we are continuing to hit all-time highs as the stock market rockets up and up and up without any ceiling, or so it seems. And so now the question that most investors are starting to ask as they look at their account hit all-time highs, as they look at the stock market go up and up and up, is now the time to sell? Should I get out now before the crash? And on today's video, we answer that question. No, absolutely not. Well, that was easy. Shortest video ever. So are we done here? All right, stick around for the rest of the video and we're gonna discuss why you shouldn't sell everything right now and what you can do instead. Let's dive in. It is no surprise that the stock market is doing extremely well recently, and so the term melt-up has gotten thrown around a little bit, especially recently, as the market has been hitting all-time highs consistently and continuously for what seems like a very long time now. Now, in reality, it's been just over a year since we've had some extreme market volatility, as last December we had a massive plunge in the stock market. Regardless, if you owned stocks over the last little over a year, you are likely doing extremely well. And so the question that's on most investors' mind right now is, should I sell? Are we nearing the top? Should I get out before there is a collapse or a crash? I don't want to lose all the gains that I currently have. What should I do with my portfolio? And this is justified because the massive increase that we've had in the stock market, especially over the last year, has really not been driven by fundamentals whatsoever. We have not seen any earnings growth. If anything, we've seen earnings declining. We've seen a massive increase in corporate debt. We have not seen any increase in wages. In fact, recently we've seen a decrease in wages. And so it begs the question, why is the stock market going up and who is buying it, contributing to all of this upward pressure? Now, as I've talked about in previous videos, most of this buying pressure looks like it's coming from the corporations themselves through stock buybacks. If you follow the trail of money, the Federal Reserve is pushing easy money out, and most of this easy money through the form of low interest credit is going to borrowers who are creditworthy. And the most creditworthy borrowers right now are going to be corporations. And so these corporations are issuing massive amounts, record amounts of debt, and the vast majority of the time what they're doing with this debt is they're just doing corporate buybacks. They're buying back their stock. That's the easiest and shortest way to have an effective return on your money. And so as we've seen corporate debt take off and as we've seen stock buybacks increase extremely fast, we've also seen a correlated move in the stock market. And in fact, for every 1% change in the Federal Reserve's balance sheet, we've seen almost a 1% increase in the stock market. So if you follow the money, it looks like the direct cause of the stock market going up at the record amounts that it is, pretty much a direct result of what the Federal Reserve is doing by keeping interest rates low and essentially doing quantitative easing right now. Now, the other thing that is unique to right now is the correlation that our stock market has to around the dot-com bubble burst, the 2000 era. We're seeing a lot of similarities. One of those similarities is the lack of short interest in the market right now. We are at a low with the number of shorts on the stock market right now, which means that bullish sentiment is at all-time highs. It means everybody's expecting the market to go up. There's very little money expecting the market to go down. And what that's translated into has been a lot of purchasing power, which has driven the market up. But purchasing power can only last as long as there's new money coming in. And with short interest being so low, and with corporate debt already having exploded, with wages not increasing, it's looking more and more like we are starting to tap out the amount of buying pressure that can come into the market and support it at these high levels. Because if any of this buying pressure flips around and starts to sell, you could see a cascade of events turn the opposite direction, where everybody that used to be short and now is not short flips to short again, and so we have a massive amount of selling pressure now instead of buying pressure. Something else that is most likely driving the stock market gains and growth right now is the index fund bubble. A lot of people have talked about it. I made a video about it earlier. The index fund bubble is, yes, it's technically a bubble just because you have a lot of money going into certain companies, not based on fundamentals, just based on the fact that those are what's growing. And so you've had a push toward indexing, especially over the last 10 years, but over the last 20 and 30 years has been the longer term trend. You've had a massive push towards indexing instead of active investing. And what that means is that a lot of money is just going into preset lists of companies without any regard to looking for the strength or the valuations of the companies themselves. And so companies that might be stronger companies with better valuations, better balance sheet, better fundamentals are not getting the same amount of buying because there's less and less investors looking for companies that are valued well, and more investors just saying, throw my money in the stock market, whatever the stock market's doing, I'm fine with that. And so whereas 40, 50 years ago, you would have had a lot more active investors right now selling some of these large overvalued companies that are getting a lot of buying right now, and instead they'd be buying the companies with the lower valuations and the stronger fundamentals relative to the higher ones. So you'd have active price seeking. You'd have a lot more money that's looking for deals in the market rather than just saying, throw it at whatever is the stock market at the time. And so this push towards indexing has led to a lot less active price seeking and price discovery in the market, which has led to a lot lower volatility. And one more piece of evidence that shows that this is what's really happening right now, that there's a huge push towards indexing and a lot less active price seeking. And so you've had value companies severely underperform growth companies because all the money's been going into the same companies that have been growing. Self-fulfilling prophecy is the fact that hedge funds are shutting down at record paces. There are less and less people willing to sit by and be patient and watch as their money doesn't grow when they could just throw it in the stock market, not pay any fees, whereas with a hedge fund, you're paying 2 and 20 and not watch your money grow. So they'd rather just take their money out of the hedge fund, throw it into the stock market where they're not paying any fees and at least get the average returns. And so hedge funds have been closing down, which means that we're likely at the end of the cycle when the majority of the new money that can come into this massive momentum, massive growth indexing approach is reaching its end. Okay, so I know I've painted a picture for you that seems like, well, everything you're telling me looks like the stock market, especially the S&P 500, is about to fall, crash, collapse. Why did you say that I shouldn't sell? Great question. I'm glad you asked. As John Maynard Keynes said, the market can remain irrational longer than you can remain solvent. So one of the worst things that you can do is make a massive portfolio adjustment expecting we're at the end of a melt up and then sit by in cash and watch the stock market for the next year, 2 years, 3 years, just continue to push forward and make all-time highs. Is that likely? No, I don't think that's likely at all. Is it possible? Absolutely. That is way too much risk to take on with your money to watch the market just run away and watch you sit in cash, especially while inflation just erodes the value of that cash. You sit there on the sidelines, just lose money while everybody else is making money. So no, that would not be smart. Nobody can ever intentionally peg the top. You never know when it's going to run out. Who knows what the Federal Reserve will do? It looks like they can continue to push this thing along. They pushed it along far longer than a lot of us thought they ever could. And so while I do think there will be some sort of a correction here soon, who knows what it will look like, and who knows if it will be reflected in the stock market measured in dollars, because if your ruler is continuing to shrink, your house is going to continue to look like it's bigger. And so if you're measuring something by the dollar and they're just shoving more dollars into the economy, your measuring stick, the dollar, is shrinking. It doesn't have the same purchasing power or measuring power as it used to. And so anything you're measuring using that shrinking measuring stick is going to look bigger. So if you can't sell and you want to protect yourself and you want to make sure that you capture your gains, what can you do besides just sit and wait? The number one thing that you should be doing is looking at hedging. Now you can hedge really easily with buying some puts. You're not speculating on a collapse, you're protecting, it's buying insurance. Buy some puts relative to the size of your portfolio so that if there is a big collapse, crash, correction, then the value of the puts that you bought will increase in proportion to how much your portfolio loses. Just hedge your account. Yeah, you might have to sell some of your shares, sell a little bit of your position in order to make up enough capital to purchase these put options. Buy them long term so that you're basically buying them in bulk. You're buying that time value in bulk so that you don't have to pay for that monthly time value just dripping out. When you're buying at the money put options, buying them further out will give you that time value at a discount. And if you don't want to sell anything to pay for that, you can sell a call on your positions as well. In addition to buying the put, that'll give you some income to pay for that put. That's called a collar. I teach options. Click on the link in the description below if you want to take my options class. Now, if you have a retirement account and you cannot purchase options in your retirement account, the first thing I would say is wherever your retirement account is at, give them a call and ask them if they have a personal choice brokerage account option within your retirement account. A lot of plans have this ability and most people don't know. Normally when you log in, you say, hey, I'm putting my retirement account money away, I'm putting my contributions in, and I can choose from these, 30 different mutual funds. But if you give them a call, a lot of times they'll have an option in there where instead of only being limited to those mutual funds, you'll be able to take all of the money in your retirement account and move it into a small subsection of your retirement account that will allow you to choose whatever investments you want. You can buy stocks, ETFs, and a lot of times you can even trade options. And so the first thing I would do is look into that, see if that's available. The second thing I would do is look to see if any of the mutual funds in the account are hedged equity funds. There are a lot of mutual funds out there that are hedged equity funds that you can choose that will do a little bit of this hedging for you. Now, full warning, obviously, if you're spending any capital, whether it's yourself or the mutual fund company, if you're spending any of your capital on insurance or protection, your overall performance is going to be worse in a bull market when everything is going up, because you're not going to have the full amount of capital devoted just to going up. You're going to be setting aside some of that to protecting yourself if it goes down. But in the chance that it does go down, then that's where that protection is really going to come in handy for you. The second thing that you can do if you can't hedge, or you don't like the idea of hedging, or you don't want to learn options, you can shift your portfolio to more of an income portfolio. Now, I do not mean bonds or CDs or anything fixed income. What I mean is income equities, dividend stocks. And if you're picking solid dividend stocks, they're going to continue to pay you your dividend regardless of what the share price does. And so you can even start to forget about what the share price is doing if you're investing for income, because you don't care. It's still paying you your dividend. If you don't need the income, you can reinvest it, or you can store it up on the side in a cash account or in a gold ETF until you find another opportunity that you want to buy. But ultimately, you don't care what the price per share is doing, because it's continuing to send you that income every month, every quarter, every year. So shifting to more of an income strategy instead of a growth strategy is going to be one way that you can protect yourself against a stock market correction, crash, collapse, because you don't really care about the price. You're only looking at the income. The third thing that you can do to protect yourself is shift your portfolio to more of a value-based portfolio. Now, this kind of goes hand in hand with income. A lot of value investing is hand in hand with income investing, but you're looking for a little bit more of strong fundamentals rather than just the income side. So you're looking at the PE ratio, you're looking for a low PE ratio, you're looking for a good PEG, and I'll probably do a video later about how to pick stocks, how to pick value stocks. If you want to see a video like that, let me know in this poll here if you want me to do a video on picking stocks, specifically value investing. But ultimately, there are some guides out there you can look. You can start to try and shift your portfolio towards more of a value-based portfolio. And because honestly, a lot of value companies have been left in the dust, especially over the last 10 years. Growth has vastly outperformed value. But long term, if you look at a much longer term view, value investing usually beats the averages. You just have to be very patient during the times where it doesn't, and you have to be willing to sustain the losses during the hard times. But ultimately, if we've seen this period of time, especially over the last 10 years, where growth has been beating value by a lot, it looks like we're nearing the end of that cycle where things might shift back into value's favor. And ultimately, the nice thing is, since a lot of the money that's been going into the market recently has been concentrated among the few best performers in the major indexes, and then the indexes overall, if you're looking for value companies, you're normally going to be finding companies that aren't even included in those indexes, which means that when everything starts to sell off in those indexes and people start selling Amazon and Apple and Google and Microsoft like crazy, your value stocks, they're not going to be getting that selling pressure because they didn't get the buying pressure to begin with. And so you can find a little bit of a hedge, a little bit of a protection for your portfolio if you're looking for value. And if you don't like picking the stocks yourself, there are plenty of ETFs and mutual funds out there that invest in value stocks for you. Now, the fourth thing that you can do to protect yourself in this market melt-up is you can shift a little bit of your money into reserves. Now, again, when I say reserves, I'm not talking cash, and I'm not talking CDs, and I'm not talking treasuries, I'm not talking bonds, money markets. When I'm talking about reserves, I'm talking about something that is actually protected from counterparty risk. If your asset is somebody else's liability, it's not really reserves. When you put your money in the bank, they loan it out. When you put your money in a bond, there's the risk of default or technical default through inflation. And so increasing your reserves, there's nothing wrong with that. At the beginning of the video, I said, no, you should definitely not just sell everything, because who knows how long this will last. But that doesn't mean you can't start to pare down a little bit and start to load up on your reserves. Ultimately, from the standard classical modern portfolio theory standpoint, this would literally just be something akin to rebalancing your portfolio, although you might have a little bit more in reserves. And so when I'm talking about reserves, it's something that's physical, stable, it's something that's inflation protected, something like gold. Even investment real estate has a little bit of those, if you know what you're doing, a little bit of those attributes to it. And so if you find yourself over your entire portfolio overweighted, especially in US growth stocks, this might be a time to rebalance and consider loading up on your reserves a little bit so that when things change, now you have a little bit of a cushion that you can use to buy things on sale. So in conclusion, it is very important to not sit on the sidelines, because there are tons of people who sat on the sidelines from 2010, 2011, 13, 14 and started getting into the market in 2016 and 17 and 18 because they just said, hey, the stock market continues to go up. I sat on the sidelines for this long, might as well get in now. And they're going to be the ones that are going to get hurt. They were trying to time the market and they bought in at a really bad price, and then they're going to probably sell once things get scary again. And so instead of just sitting on the sidelines, it's important to just invest intelligently and shift your portfolio between your reserves, your growth, your value, your income appropriately, and not just completely react with fear on a day in and day out basis. Don't get swept into the euphoria, because there's a lot of euphoria going on right now. The greed index is at all-time highs. It hasn't been this high in a long time. And as Warren Buffett likes to say, be greedy when others are fearful and be fearful when others are greedy. So don't get swept into euphoria. Lots of people are loading up on calls right now. We have the most call buying action that we've ever had in the market. It's a record at this point. So it's really important to remember that markets don't die of old age, they die of euphoria, because that euphoria stage is when all that final buying comes in and allows some of the big money to finally start to get out, and it triggers that sell-off and triggers the reversal of that trend, that momentum that has been taking it up for so long, waiting for all the final buys and all the final money to get in right at the end. Now, you might be asking yourself, well, why not just write it out? If you look at the last 100 years, 150 years, markets go up, right? What's the harm in just writing it out, especially if I'm young and especially if I have time and I'm going to continue to contribute when it goes down? Sure, that's a valid response. But the important thing to remember is that if you do any of the above mentioned, if you hedge your portfolio, shift to income, shift to value, increase your reserves, you're still going to be making money. You still have intelligent exposure to the market. You're still making income on your income investments. You're buying things at value. You're buying insurance just in case things drop. And so if you do any of the above mentioned, you're still going to be making money. And you're going to be doing it intelligently to position yourself so that you have the means to buy things on sale when they are on sale. And the other thing to remember is that yes, markets have gone up. If you look since 1998, gold and the S&P 500 have had just about the exact same total return, about 430 to 440% total returns. Bonds and equities have again had about the same performance. And so a lot of this growth that we see in the stock market, when adjusted for real inflation, when you measure it differently than just dollars, because again, inflation makes those dollars kind of useless as a measure, it's important to diversify in non-correlated assets and make sure that you're value investing and investing for income, because you can't trust just growth. As long as you're getting paid income, you know you're actually getting paid. There's actually return on your investment. And when you're hedging, you're protecting yourself against those collapses so that you have the means to do something when the opportunity arises. And you don't have to just sit it out and wait another 10, 20, 30 years, or in the case of Japan, even longer, when there is a big crash. Thank you so much for watching. I really appreciate it. Let me know your thoughts. Let me know your questions. If you enjoy the content, help me out. Hit that like button and that subscribe button for the YouTube algorithms. Thank you so much. It really means a lot to me. You guys have a great day.